The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He's my good buddy. He really needs no introduction whatsoever. His name is Brent Johnson. Brent, welcome back, buddy.
Thanks for having me, George.
Now, before we get going, I've got to promote Rebel Capitalist live because I do a terrible job of doing it. My digital marketing guy, Gene, I think you know Gene. He's always saying, You mention it for heaven's sakes, George. So you're going to be joining us at the next Rebel Capitalist Live in Miami. This is June 24th through the 26th. Doug Casey, Kiyosaki, Snyder's going to be there. I don't know if
I know. I saw. I just looked up the on the website last night and I noticed that. Yeah.
And Joseph Wang. So I think I might do a panel discussion with Joseph, with Snyder, probably me, you, Joseph, and Snyder. And I think that'll be really, really cool. So anyway, you guys, you got to check it out at rebelcapitalistlive.com. All right, getting back to the interview here, I want to talk first and foremost about the DXY. I mean, I think we got over 104, and I believe that was the highest level since 2002. So you know more about this stuff than I do. What are your thoughts?
Yeah, well, I mean, it's just a reflection of what's going on in the world, and it's kind of the point that I've tried to been making for the last several years, is that the dollar is a horrible currency. I'm the first to admit it. The U.S. has so many problems. It's just that the rest of the world has them too, and the rest of the world doesn't have a lot of the advantages that the U.S. has. And despite these high CPI prints, despite the twin deficits, despite the shine of the American shining city on the hill, despite that kind of waning into the distance, the dollar's still the only game in town when it comes to a global currency. Europe has a lot of problems. Japan has a lot of problems. China has a lot of problems, and it's getting reflected in their currencies. And the antithesis of problems in those currencies is a strong dollar, and that's what we're seeing. And yeah, I saw it jumped over 104 earlier this morning, and now it's backed off a little bit. But I mean, it's had a heck of a run. Yeah. It's last summer, I think it was at low 90s or something. So it's up 10 or 12% over the last 9 months. And, it wouldn't shock me at all if we get a little bit of a pullback at some point. It's due for a breather, but the problem is the rest of the world, again, continues to experience problems. It's hard to see a meaningful fall in the dollar.
Let's address that. I know we've done it a ton of times, but it's so hard for people to get their head around. So before we move into some more esoteric stuff, how can we have consumer price inflation? How can we have an 8.5 CPI print and the dollar go up? How is that even possible?
Well, a lot of time. Okay, so you're right. It's good that we talk about this because this is, it's first. I will say, a year ago, there's no way the DXY is going higher. And then as the DXY started going higher, they're like, well, yeah, the DXY is going higher, but the dollar's not going higher, right? And, and they'll say, well, the dollar's only going higher against other fiat. It's not going higher versus anything else. Well, now look at equities. It's going higher versus equities. Look at copper. It's going higher versus copper. Look at soybeans. It's going higher versus soybeans. But now this can all change tomorrow, right? But in general, yes, the purchasing power of the dollar over the last couple of years has fallen. It's just that it hasn't fallen as much versus the dollar, or the dollar's purchasing power has not fallen as much as everybody else's.
Right.
So we could very possibly get into a situation where we have a spiking DXY alongside very high levels of inflation. And that is actually the dollar milkshake theory.
Right.
Believe it or not. That's why I even said we will eventually get into a situation where the Dow, the dollar, and gold are all rising together versus everything else. And it's because fiat is measured against each other now. And I know then here's the other thing I'm gonna address it right away.
Sure.
Is people say, well, it doesn't matter if the DXY is going higher because all fiat is losing value. It's just which ice cube is melting the slowest. And I can tell you that there is some truth to that. Yes, it is very important to understand that all fiat is losing purchasing power. But to think that you can just ignore the DXY and ignore the fact that it's the dollar melting slower than all the others is completely and utterly wrong.
Yeah.
If it was any other currency melting slower, it's not as big a problem. But when it's the dollar, which is the underlying currency for the entire world economy off of which the entire world economy is levered, the ratio of the dollar to other currencies is extremely important. Because if the dollar weakens slower than all the other fiat currencies, you will get bankruptcies, you will get defaults, you will get margin calls, and you will end up with a cascading liquidity crisis, just like we had in 2008 and 9, and just like we had in 2020. So the idea that you can just ignore it because they're all losing value is completely wrong. I'm not saying that to be right. I'm actually trying to help people. Believe it or not, it's just not me being a troll, right? I actually, the reason I do all this is I want to help people. Now, sometimes I try to do it with a little humor. Sometimes I do it with sarcasm, and sometimes I do it with a blunt instrument. But the whole goal is to help people understand how the system works and how the system is designed. And so, anyway, I kind of got off on a little bit of a tangent there, but I think it's important to set that stage.
Yeah, absolutely. And the argument and the pushback that you get a lot is, oh, well, Brent, the Fed is going to print so much money and the government's going to print so much money. And I think your pushback is always, well, yeah, you're right. But the BOJ and the ECB, they're going to print a heck of a lot more. And so there again, it becomes something that's relative. And for people to really get their head around kind of that concept you were just referring to, if the dollar's going up, that's a big, big problem for the global economy. If you've got a rental property, let's say just one, single family home, and your mortgage payment is, let's say, $1,000 a month for this rental property, and currently you're collecting $2,000 a month in rent. So that's great. So your rent covers your expenses. You've got some positive cash flow. But let's just say that your $2,000 in rent is not denominated in dollars, although that's the equivalent that you're getting in dollars right now. Let's say it's denominated in yen. So they're actually paying you a set number of yen per month that currently is $2,000. But if that yen goes down significantly, if it depreciates against the dollar, then when you take those yen and turn them into dollars to pay your debt, you've got a heck of a lot less dollars. So you could get to a point where the yen depreciates so much that now you only have $1,000 worth of rent coming in for the same amount of yen that your rent is priced in. And now all of a sudden you're upside down and you lose your property to the bank because you can't afford to pay the mortgage and all the other expenses that go along with it, and you go bust. And you don't pay back that loan. And then what happens to the bank? Well, if you don't pay off that loan, then that reduces their balance sheet capacity, and they might not, or they may be less willing or less able to lend more dollars in the future. And if less dollars are lent out to other homeowners, that means less aggregate demand for homes, and all home prices come down. Is that an example?
And it means less dollar supply or potentially less dollar liquidity. So you get into it all becomes kind of a vicious circle.
Right. So then the cash out refi, people can't do cash out refis, and et cetera, et cetera.
Right.
Yeah. Right. So I just wanted to paint that picture, because I think that's an example that most people can relate to. But it's the exact same concept that you're talking about, but just at a global level with all these global corporations.
Right. And it's a huge problem. The world economy and the global monetary system as it's currently designed is not designed for a continuously strong dollar. It's just not. Right. It breaks the system. It will literally break the system. And so how they're going to solve it, I don't know. I think eventually the way it will get solved is, maybe we'll talk about this, but I think it's going to eventually have to be reset lower, either artificially or just because there's a catastrophic bust of some kind. But I think they're going to have to reset the dollar much lower, or perhaps just introduce an entirely new system, because it's going to be very, very hard to fix the system as it currently is.
Yeah. So the Plaza Accord 2.0 type thing.
Yeah.
How would that work? I'm sure you've given this a lot of thought. Like how would the applicable countries come together, and how would they artificially or repeg the dollar? I don't know if you want to use that term, but like how would it actually work in practice?
Well, I mean, the way it typically works is the hegemon says that, hey guys, this is what we're going to do, and then they enforce it, right? And but what typically what they would do is what they did in the 80s is, the Fed went to the Bank of Japan and the German central bank and the Bank of England, and they said, listen, the dollar is way too strong. We raised interest rates dramatically over the last 5 years, 6 years in order to cure inflation. And that happened. But now the dollar is very strong and it's hurting us. It's causing us to have, a recession in the United States, which, we're the king and we don't want that, right? Basically is what they said. And so they went, and so they said, we want to devalue the dollar, via these Plaza Accords, basically agreeing that, they would buy their own currencies and strengthen their own currencies versus the dollar, and let the dollar lose value over the next, 2, 3, 4, 5, 6 years, whatever it was.
The German central bank and the Japanese bank just went out to the market, just bought yen and bought.
Essentially, yeah. I don't know the exact transactions by which they did it, but yeah, they basically,
they're getting dollars coming in from their exports, and they're like, okay, we'll just take these dollars.
They take those and
yen.
That's right.
That increases the supply of dollars.
That's right.
The supply of yen, then you have that balance.
That's right. And again, did Germany and Japan want to do that? They probably didn't want to do it, but they agreed to do it. And, and then that actually, the dollar fell significantly. And then, we got into the 90s and, the dollar had come down quite a bit, but then it started to get strong again. It went up into the 2000s, and then they had to start cutting interest rates. And then, Greenspan did a number of interest rate cuts, and, the dollar, got to, it was around 75 or something in 2007, 2008.
I think it got down to 70 actually.
Yeah, maybe down to 70. But then with the global financial crisis, the supply of dollars dried up. The dollar started to rise. That started a whole cascade of things, both in the euro dollar market and the US dollar market. And so the Fed came in and had to do QE, and they had to, kind of flush the situation when the dollar came. But, again, it's important to understand that over the last 30 years, the dollar has been systematically weakened, not strengthened, right? The efforts of the central bank have not been, everybody talks about the US dollar dying. They're going to print so much money, it's just going to blow away into oblivion. And I get it. Fiat currency does lose value over long periods of time. But it's important to understand that the official interventions into the US dollar have always been to weaken the dollar, not to strengthen the dollar. Now, I would say, Volcker in the late 70s, early 80s, he strengthened the dollar. They went in and raised rates, in order to get the dollar stronger. But everything since then has been to get the dollar weaker, because the dollar, without, if left to its own devices, because of all the debt in the world and all the demand for the dollar, it would just continually go higher and higher. And so they have, and when it starts to break things, then they have to come in and artificially weaken the dollar. So, I think a lot of people perhaps unwittingly have this turned around in their head of what it is that the Fed is doing, right? The Fed's not there supporting the dollar. The Fed has been in there trying to keep the value of the dollar manageable at a lower level.
Yeah. When you're saying that, I'm thinking about the trade deficit. I mean, it's gone from about 40 billion to 120 billion per month in the last 2 or 3 years, something like that. And I just think about, that is an argument for the dollar being weaker, but my goodness, if we were running a trade surplus, as an example, I mean, the dollar would be at 115, 120,
Yeah.
something like that.
Easily.
And what happens to the global
Yeah.
economy then? And my
Yeah.
goodness. So where do you think that line in the sand is for the central banks, where they say, we just cannot handle the dollar at this level, we have to intervene?
Well, I think it depends on whether if you're talking about the Fed, or are you talking about other central banks, or are you talking about them all together? Because I think there's different answers depending on which one
Yeah,
you're talking
right.
about.
Well, where they come to this a collective agreement that, hey,
Yeah.
toward 2.0, we need to make this a reality.
Well, so this is where it gets a little tricky. Again, over the last couple of years, let's call it the last 12 years, since 2008, since the global financial crisis, for the most part, governments and central banks have had kind of a unified policy. In other words, they've kind of been working together to keep the system going.
Right.
The problem is that since COVID, and even the initial response to COVID, everybody kind of came together and coordinated policy, both fiscal policy, central bank policy, et cetera, et cetera. But now, over the last year, kind of started with Trump. It's kind of picked up steam lately, especially with what's going on with Russia and Ukraine, and the tensions with, China and Taiwan. We've kind of gone into this fractured, multipolar, bipolar world. Rather than one world where everybody works together, we've got, two camps again, which is what we kind of had in the early 80s, late 70s, early 80s. Think about that. In the late 70s, early 80s, we didn't have this globalization, right?
Yeah.
But then, after the Plaza Accords, a couple years later, then the wall came down, and then we had 20, 30 years of globalization, coordination, everybody working together. But, so the pendulum was on one end and it swung all the way to the other. But now, that pendulum is starting to swing back, and we're kind of moving back towards a bipolar world rather than this unipolar world.
Yeah, something
and
you
so now
we probably agree on.
Yeah, we totally agree on it. And that is causing fractures. It's causing fractures in supply chains. It's causing fractures in trade. It's causing fractures in geopolitical allegiances. And it's causing problems in the monetary system, because during that 30 years of globalization, the amount of dollar debt in the world, and the amount of dollar trade in the world, and the amount of just the use of the dollar as the global currency just went exponential. And so the amount of dollar debt, the amount of dollar obligations, they really went through the whole euro dollar market just exploded, right? Yeah. And so now we're swinging back the other way, and now we no longer have coordinated monetary policy. The U.S. is raising rates, but Japan is not only not raising rates, but they're keeping rates low. They're doing yield curve control. They're basically have so far chosen to sacrifice their currency in order to save their bond market. We can talk a little bit about that if you want.
Yeah.
Not too much different in Europe. They're not doing yield curve control yet, but they still have negative interest rates. They still have or rates at zero. They're still doing QE. The yen is off significantly from its high, and so and we those are our allies, right? Then you go to China and Russia and some of these, and Saudi Arabia. I mean, you've got these diverging monetary policies where there's not coordination anymore. So the reason I'm mentioning that is going back to, how would a Plaza Accord type thing work, or at what level would the central bank come in and do something? And I am of the belief that the Fed is tightening right now because they can, because our economy is stronger than the rest of the world's. Now, that doesn't mean it's stronger. Again, this is a relative game. The big asset allocators, the big investors do not have the option to just sell everything and go sit in cash and watch. So they're going to place their money somewhere. So it's a relative game. And on a relative basis, the U.S. Equity market, or the U.S. Economy, I guess I should say, looks better on a relative basis than many of its peers. And so, and because of the inflationary pressures that are existing, they're raising rates to combat those inflationary pressures. I think that the part of the reason they are also raising rates is I think they're trying to stick it to the rest of the world, especially the emerging markets. Anybody who's on the fence about whose side are you going to choose? Are you going to go with the West, the United States and the West, or are you going to go with China and Russia? You're going to have to pick. And I think part of the reason they're raising rates is to put pressure on anybody who's kind of dithering on which side they're going to go with. In other words, if you are going to go with Russia and China, well, you ain't getting a swap line, and we don't really care what happens to your economy. Right. But if you play ball with us, then yeah, maybe we'll take it a little bit easier on the. But in order to extract that leverage, you have to put on the pressure first. And so I think a big part of what they're doing is putting on the pressure to the rest of the world. I think they're going to make the rest of the world make a decision. And I think part of it is also that they're just extremely arrogant, and they think that they can just flip on a dime whenever they want, and they can totally control the economy. And if it turns back down, they can go back to QE or whatever program they have involved and save the day again. Now, I don't happen to agree with that, but I think that they think that. So I think that's so where, at what level, would the central banks want to devalue that? I think it's much higher. I think it's much higher. I don't think I think the Fed wants the dollar higher right now. I think the Fed wants the dollar above 105, maybe 110. And I think they know it will cause problems. And I don't think that they care right now. I think their main care right now is getting inflation under control. That doesn't mean getting it back to zero, but getting it under control. I think they want to get Biden reelected. The last thing they want is to get Trump back in the White House. Right. And the biggest knock on the administration right now is in the problems with inflation. You haven't done anything to attack inflation. So I think the Fed wants to show that the administration is working on inflation. And I know there's some people out there saying, yeah, but the Fed doesn't have anything to do with the president. They're independent, and that's bullshit. They're not independent. Just forget about it. And so I think that's a big part of it. And so, I don't know at what level we're going to get to. I think that they're going to keep raising, they're going to keep tightening until something breaks. And whether that happens, whether they can get one more interest rate hike before that happens, or if they can get 4 more before it happens, I really don't know. I think a lot of people say, oh, they can only do 1 more, or they can't do 1 more. And nobody knows how many more.
The question is, what do they want to break? And it's interesting. I never thought about that, how their domestic monetary policy is kind of in line right now with their foreign monetary policy, meaning that that they need to bring down inflation for the Biden administration. So okay, great, we'll raise rates, and hopefully stocks will come down, decrease aggregate demand. Okay, bring the CPI from 8.5 down to 8.2, hopefully to 6 to 5. And then that gives us some wiggle room if we break it too much to come in and start printing again, or taking rates back down to 0 or whatever. And then at the same time, this policy is taking the dollar from 102 to 105, potentially to 110, and just crushing everyone out there, every one of these other countries, to where we can pick and choose and say, oh, you've been good, here's a swap line to where you get the dollars you need. Oh, you've been bad, no, you're done. And so that I never thought about how those 2 monetary policies are kind of in line right now for the Fed.
Yeah, I mean, this is the heart. We have been driven right into the heart of Triffin's dilemma. For anybody who's not familiar with Triffin's dilemma, it says when one country's domestic currency is also used as the global reserve currency, eventually there will come a time where the needs of the domestic country or the domestic economy come into conflict with the needs of the global economy. And that's where we're at. The domestic economy needs higher rates. The global economy does not. And so far the domestic economy is the one that's being catered to.
So and this kind of break, Brent, do you think they're trying to break the stock market, or they're trying to break those other countries, or both? I mean, or the bond
I think a little
market?
bit of both. I think a little bit of both. We'll see. And this kind of gets back to kind of what I've been talking about for the last couple of years, is that because we are the global reserve currency, we have great demand for our currency, whereas the rest of the world doesn't have as much demand for their currencies. In other words, we have demand outside of our domestic market, whereas other currencies don't. So we can afford to raise rates because we can print dollars to fund the U.S. debt if we have to do so. Now, so far, we're raising rates. We're doing QT. So far, we're not printing. But we could, we'll probably have to go back and do that at some point. But the rest of the world, they don't have, I mean, they have the worst because they have inflationary pressures in their local currency terms, but they have deflationary pressures in US dollar terms, right? So they're getting stagflation, which is, but not only it's like almost like hyper stagflation. And this is how you get hyperinflation. And I think we've talked about this before, as I personally think hyperinflation is so overused that it's lost its meaning for most people.
Yeah.
Like, but this is the type of an environment where another country will experience hyperinflation because they have to print their local currency, which nobody wants other than local, vendors or individuals. And even they don't want it, but they're forced to use it. But as their costs rise in dollar terms, and they end up having to print more and more of their local currency, and the currency ends up failing.
You get the dollar denominated stuff they need.
That's right. And so, and that's how it happens. And so, it's Triffin's dilemma writ large is really what it is. We can continue to do what we're doing. When I say we, the U.S. can continue to raise rates for a while. Now, maybe that will fall. Maybe that will fail. Maybe they will have to reverse course at some point. But the point is the rest of the world, or most of the rest of the world, has already failed or is already failing. Right? There are the problems that many are talking about that will happen to the US are already happening to Europe and to Japan, which are two major economies, right? But it's also happening to China. China is in a load of trouble economically. And when their economic problems become more clear, then their social problems are going to become more clear as well. And so I think that the US is doing this because, number one, I think they want to just re-exert their dominance, quite honestly, right? It's the bully, the bully has gotten challenged, and the bully is saying, listen, we're still the big man on the block, and they're reinforcing this to their allies. They're saying, listen, you're our allies and you're our friends, but listen, you still owe allegiance to us. And then they're also doing it as a warning to anybody who's kind of on the fence. And then I think they're doing it to punish anybody who is already on the other side. Yeah. I mean, maybe I'm overstating that case, but I don't think that it can be ignored.
Yeah. Just like Russia's using energy to try to flex their muscle, we're using the dollar to try to flex our muscle as well.
Well, I'm glad you said that, because here's what I find funny is that, over the last, call it, couple months, as Russia has come out and done this, and listen, I feel like many people are mistaking the fact that Russia has a pair of pocket aces, and I will admit they have pocket aces. They've got oil and energy, right? Big country, and so, but I think a lot of people are confusing pocket aces with a full house, right? Just because you have pocket aces, that's fine, but if your other cards are 2s and 3s and 4s, those aces don't help you that much. And the fact that Russia has come out and said, we want you to pay for our oil and gas in rubles. It's a very smart thing for them to have done. I get it. Okay. Kudos to Putin. Well played. But what has it really changed? Has anything really changed as a result? The ruble's gotten stronger, partially because of this the rule that they've put in, but partially because nobody's allowed to sell the ruble. Corporates can't sell the ruble. They have to hold it. As soon as they get any foreign currency, they have to sell it and buy the ruble. And so, but this move has allowed Putin to strengthen the ruble to where his populace is not going through super high levels of inflation that they would be if the ruble was at 120 or 150 or 200 or whatever. But I find it funny that when Putin says we are going to make you buy our energy in rubles, it's a genius 3D chess move that nobody could have foreseen. But when the US says, no, you're also going to continue to buy our oil and our products in dollars, well, it's just the sign of a dying hegemon who's forcing the rest of the world to do something they don't want to do.
Right.
It's the same thing. It's the exact same thing. But people view it through these different lenses where one is good and one is bad. And I think what I would encourage people to do is you need to stop thinking about this is good and this is bad. I am here to tell you that all governments are bad. There's no morality amongst them. Okay. So stop saying this is what should be done. This is the moral thing to do. If you can get that out of your mind, you're going to have a lot better time analyzing what's going on.
No,
and if you stop, because there is no moralizing at the geopolitical level. It's just all about power. And so if you start viewing the world through a lens of power as opposed to morality, you are going to get through this a lot easier than if you kind of clutch your pearls and say, this shouldn't happen.
Yeah, exactly. I just, we were saying before we started the interview that I just spoke at Mark Moss's event on Saturday. And one of the points I made was about Machiavelli and the book, The Prince. It is a 90-page book that was written, I believe, in the early 1500s. And if you want to know how politicians think, and I don't care where they are, Russia, United States, Ukraine, UK, Germany, pick your country, doesn't matter. Go out and read The Prince by Machiavelli, and you'll start to understand geopolitics in a much, it'll be all far more clear if you read that book. And then once you see things through that lens, then all these actions that the governments are taking, they really fall into place. And again, they'll make a lot more sense for sure. Absolutely. One thing I wanted to, a quick story I wanted to tell you, Brent, that really illustrates kind of your whole theory, I think. And for Americans, I know sometimes it's tough to kind of get their head around because it's all relative, and we see all the high rates of consumer price inflation here and huge negative real yields when you compare the CPI with the 10-year and the dollar depreciating against all the stuff that you're buying daily. So in Rebel Capitalist Pro, which Brent is one of our pros there, as you know, we do live streams, and I do them once a week where the pros or the members ask us questions directly. And we've got a member from Turkey, and they asked me a specific question. That basically the question was, what do I do? Right? You always get that question, but they gave me all of the headline numbers from Turkey before they kind of asked the main question. And I had never thought of it, or I'd never seen it through that lens. And so what they said is, listen, the Fed funds rate, or their central bank rate, their overnight rate, 14%. Okay. Their 10-year bond, I think, was trading roughly 20%, something like that.
Yeah.
Okay.
Yep.
Their official headline CPI was 60%.
60. Yeah.
And they said, in reality, it's closer to 150%.
Yeah.
And so then they said, okay, well, what do I do? And oh, by the way, real estate has skyrocketed, even in dollar terms, and so it's not like that's cheap to, a safe haven for your money. And
their stock market too. Their stock market has been going up.
Yeah, but you're still losing purchasing power.
Yeah,
they gave me that number too, and that's still less than the rate of inflation. Gold, you did okay. And so, I thought about it. I'm like, you got to buy dollars. like that's it. You got to buy dollar, or you got to buy treasuries. You got to buy gold dollars or some sort of dollar denominated asset. And it just kind of dawns on you that, okay, I get it now. And then you look at what Japan is going through, where, I mean, you could give me the details on what the yen has done. It's just absolutely fallen out of bed. But it's the same thing. If you're a pension fund in Japan, what do? And another thing I want to highlight, and then I'll let you kind of riff on that, is as Americans, we have to understand that Japanese don't buy stuff denominated in dollars. They do, but not the consumers, right? Their stuff is denominated in yen. So they don't care what the CPI is in the United States. That is irrelevant to them. What they care about is the cross rate between dollars and yen. And if the dollar is going up against the yen, even if it's going down significantly against consumer goods and services in the United States, they're still increasing their purchasing power. So do you want to buy a 10-year Japanese a JGB at what, 0.25%? Or would you rather get a 10-year treasury that's not only paying you 3%, but also where the dollars that treasury is denominated in are appreciating in value against the stuff that you're buying daily? And so I know I'm kind of preaching to the choir here, but what insights would you add on top of that?
Well, I just think that that's the point I'm glad you're making that point, because, it's a big world, and it drives me crazy when these people, they just focus on the US and they say, the US inflation rate is this, and the US deficit is this, and the US interest expense is this. And the people that are saying this, they have no idea what the interest expense is in Japan. They have no idea what the interest expense is in Europe. They have no idea what the entitlement payments are over there. And those, and the demographic problems of these other regions. And it's a big world, and capital can flow kind of wherever it's best appreciated. Now, capital controls are going to start to go up in the years ahead. That's, we haven't had a lot of capital controls for the last 10 years. I think we're going to see a lot over the next 10 years because capital will be flowing around. But this is the point, is the rest of it's my opinion, and maybe I'm wrong, but it's my opinion that the big majority of people who think that the dollar is going to zero are Americans. And they're kind of these self-loathing Americans who think that the US has lost its way, which I will agree with, and I'm disappointed in the arc of history with what's going on as well. But they don't realize that it's even though we are not where we once were, people from other parts of the world still have it worse than we do, right? Yeah. We kind of have the luxury of hating ourselves. In other words, we have it so good, we have the luxury of thinking how bad it is. But there's a video going around. I should find it and send it to you. And it basically talks about what you were just talking about. And it goes to countries like Turkey and Egypt and Argentina. And it's, it talks about these people who have lived through high levels of inflation. And so what do you do? How do you fight against it? And literally they all say, as soon as we get money, we go buy dollars. And then somebody in another country, we go buy dollars. And again, you don't have to like it, but just understand that, it's the common knowledge game, right? It's when you have in the common knowledge game, you're not supposed to vote for what you like the best. You're supposed to vote for what you think everybody else likes best. And I think this is going to continue to happen. Again, Japan is not going to be able to have the yen dramatic appreciably without sacrificing their bond market. If they sacrifice their bond market, then their banks, their insurance companies, their pension funds all fail. It's like, I'll use Luke as an example here because I get asked about him all the time. And Luke does a very good job of explaining the challenges that the US has.
And I want to play devil's advocate next, because I think I understand Luke's and Peter's position. So I want to I'll play devil's advocate next topic here.
Well, so I mean, the point that those two gentlemen will make is that the U.S., we've got the twin deficits. We can't let interest rates rise appreciably because we can't afford it. We have so much debt. If interest rates even go up 1%, that means the interest rate is now over $1 trillion a year, et cetera. And I get it. That's absolutely true. But it's even more true for these other countries. And these other countries are already in that situation, which we are not yet in. So again, on a relative basis, I believe that there is going to be a progression and an order in which the dominoes fall. Yeah. I am not going to say that the US domino will not fall. I think the US domino will eventually fall. I think all these other dominoes fall first. And I think, listen, I can be wrong. I've tried to say this in every interview I ever give. I'm pretty confident. I'm pretty stubborn. That's a result of being the son of Bruce Johnson. That's just the way it is. But if I'm wrong, I will admit I'm wrong. There's no guarantee that I'm right. I think I'm right, but I could be wrong. But I haven't seen any evidence that those others that we are going to fall before those others. But I've seen a lot of evidence that those others are going to fall before us.
Yeah. Do you think there's an argument for us, the United States, having a better transfer mechanism to get those dollars or newly created currency units outside of the country and circulating in the global FX market to bring down the level of that currency. So in other words, it is true that Japan is going to have to, let's say, print a ton of money, but they're running a trade surplus. So therefore, it's tough for those yen, those excess yen to get outside of the country to really affect the yen against the dollar, where our trade deficit is getting higher and higher and higher and higher and higher. Therefore, that's a transfer mechanism to get all of those newly printed dollars that we're going to have to print to fund Social Security and all these, and Medicare and all the unfunded liabilities that Luke would mention. We've already got that fire hose, if you will, spraying the world with dollars. So is it just that the global dollar denominated debt is just so massive that it can absorb any type of fire hose of dollars that we can provide, even if our budget deficits are going from 5 trillion to 10 trillion to 15 trillion to 20 trillion dollars?
I would argue that it's the latter.
Yeah.
And this is the thing, the system will get bigger until it collapses. And that's why I say the dollar will keep going higher. The more they print, the higher the DXY will ultimately go. Because the more the Fed prints, the more Japan's going to have to print. The more Europe's going to have to print, the more China's going to have to print. And it just keep boom, the bubble just gets bigger. Now, eventually it will collapse, right? But there is so much demand for dollars in the euro dollar market,
right, that
we can get away with printing a lot more than the rest of the world. Again, if you look at those charts that show how much they printed or how much QE they did versus the Fed balance sheet or versus each central bank balance sheet, right? And in that, the Fed is lower than its peers. But if you actually use the denominator of the euro dollar market rather than just the domestic US dollar market, it becomes even lower than everybody else. So in other words, like the denominator that is used in those charts when looking at the dollar is, in my opinion, incorrect. The denominator is actually much bigger than that because of the euro dollar market, which nobody can measure. Anyway, this is,
and you're looking at the supply, basically, guys, Brent's talking about, you're looking at the supply demand equation for dollars domestically when it's the global currency. So you're just looking at a very small fraction of the overall pie.
Right.
Okay, let me look at my next question here. So I was reading the news, and correct me if I'm wrong, but China is trying to prop up the yuan. Was I getting that correct? And why do you think they're trying to do that? And what's happening there?
Well, the yuan is a pegged currency. It's not pegged to a single, it used to be pegged to the dollar and it would float within a band of the dollar. And then 4 or 5 years ago, they manage it to a band of a basket of currencies, but it's still, and it's been strengthening over the last couple of years, since COVID, it's strengthened. And it got way to the higher, to the stronger end of that band. But again, it is a managed currency. It's not a free floating currency. It's not just the market determines what it is. And they do that because when money would get sent to China to be invested in China, it would get, so that you'd wire dollars to Hong Kong or Shanghai or whatever it is, but you can't invest dollars in China. You need yuan.
Right.
So then the central banks now have dollars. What do? They give them to the commercial banks, give the dollars to the central bank, and the central bank gives them newly printed yuan. And they go invest that yuan into the country. Now the central bank now has those dollars as reserves. They can either use it for a war chest, they can invest it in treasuries, or they can use those dollars to buy yuan to keep it artificially strong.
Yeah,
right.
International market. Okay.
And that's part of in addition to interest rates, they do it by interest rate management, but then also they can buy it on the open market to make it artificially strong. Now, over the last couple of years, the yuan strengthened because there was so much flows going into China because U.S. treasuries were at 0%. You could get 2.5%, 3% yield on a Chinese treasury. You wanted to invest in China anyway. It's a growth market. So, they got the flows and they were able to keep their currency strong. But all that has reversed now. over the last year, their stock market their stock market's down 50%. Their real estate market is under extreme pressure. Right. They've got half the country locked down now with COVID. There's no economic velocity. There's no velocity of the yuan. Transactions aren't happening. And so not only are dollars no longer going into China, but now they're starting to flow out. And so it's my belief that they will not be. So, and because you can now get paid more to own a US Treasury than to own a Chinese Treasury. So the premium of, to take the risk of being in a currency that's not easily convertible is gone. So, that's part, and I don't think that those flows are going to reverse anytime soon. In other words, I don't think that you're going to start to see money flowing back into China.
Right. So they're trying to prop up their currency to maintain the peg.
That's right.
But the question is, when do they run out of dollars to do that?
That's exactly right. And my opinion, and at some point it becomes a fruitless venture, right? You can use your dollars to buy yuan that are eventually going to lose value anyway, or you can keep those dollars and use it to buy oil and food, because you're running out of dollars to do those anyway. So you have to decide: do you want to keep propping up a peg that's going to fail anyway, or do you want to use those dollars for more important things? And listen, I don't know. Countries are very good at keeping these things going longer than you think possible, right? So it doesn't necessarily happen tomorrow, but I think it's inevitable that both the yuan and then the Hong Kong dollar, who I kind of see them as a pair deal, will be devalued.
What do you think about the stock market? Because I understand your position with all the dollar flows coming in from, like, that Turkish gentleman. What is he going to do? He's going to buy Coca-Cola or something like that. But then we've got the Fed raising rates. We've seen what's happened to the stock. Obviously, the stock market doesn't like that, especially the Nasdaq. We've. How do you? Go ahead.
I think that over the next, let's call it 2, 3, 4 years, that equities are going to end up much higher than they are right now. Because I think when we get into this, and it's just starting, it's just started. We're not into it yet. Again, my whole milkshake theory is really a framework for how I see a global sovereign debt crisis playing out. It kind of feels like it's starting now. 3 years ago when I first started, I got the timing wrong. I was way too early, but I kind of feel like now we're kind of getting into that time frame. And I think when we get into this sovereign debt crisis, when foreign treasuries around the world are rejected because they either don't believe that they're going to ever get paid off, or they're not yielding them a high enough return to make up for the inflation in those countries, I think that will cause a currency and sovereign debt crisis. And I think when that happens, the United States is going to get safe haven flows. And I think when that happens, U.S. equities, especially the big blue chip ones, the Dow names, the S&P and the Dow names, will do better than people expect. Now, that doesn't mean that it's going to be in a straight line. We've been pretty cautious on equities all year. We've had them hedged most of the year. And I expect equities to go lower now. I think at some point in the next month or so, we're probably going to get at least a short-term tradable bottom. Maybe we'll get a 2 or 3 month bounce out of it. But then I would expect, and again, I reserve the right to change my mind, but I would not be surprised at all if a year from now equities are lower than they are today. But then I think at that point, we're going to be into the sovereign debt crisis. And I think at that point, it's very possible we get a move higher in equities that's going to surprise people. Again, I reserve the right to change my mind, but that's kind of my thesis, is that when we really get into this, full sovereign debt and currency crisis, that the U.S. is going to be seen as a safe haven. It's going to get safe haven flows, and that as all bonds kind of lose value, U.S. equities rise.
Yeah. And I think the main takeaway there is just to understand how many cross currents are always at play. And you've got the cross current, people get hyper focused on the Fed raising rates and breaking the stock market. I'm one of those people. But you have to remember that there's also a cross current pushing against that, of all these flows coming into the United States, trying to buy stocks just to maintain their purchasing power in country XYZ. And it's always this, these forces are happening at all times. It's what force is overpowering the other force. What do you think about?
Can I make a point on that really quick? I think this is really important. And again, people are always saying to me, the biggest criticism I get is because I'm, such pounding the table on being a dollar bull, saying the dollar is going to go higher. Again, not because I want to be right, but because I want people to understand. I actually want to help people, right? I want to say, listen, the dollar might not die. It might go higher. And this is why. But one of the, and one of the challenges that I get back, or one of the criticisms I get back is, Brent, how can you not see what is happening? China and Russia are doing bilateral deals. So-and-so no longer wants to trade in dollars. The rise of crypto is showing that there's a need for another parallel currency system. And to their point, you're right. That is stuff I need to pay attention to. And I do see it. I agree with you that that is happening. But if I turn that around, I want to say to the people who are saying that to me, I often get told, how is the US government going to fund itself? Who is going to buy their bonds? What happens when the Fed has to buy all of them? Okay, very good points. That is definitely something I should pay attention to. But if you go and you look at the Treasury auctions year to date, we have not had any trouble selling any Treasury bonds. Not only have we not had any trouble selling any Treasury bonds, we've had massive foreign demand coming in and buying our Treasury bonds. The third thing is the US Treasury just came out and said, we are going to issue less bonds in Q2 than we initially expected because we have enough money. So, but if you look at Japan and you look at Europe and you look at China, the same thing isn't happening there, right? Their central banks are still buying all of the debt. There's no foreigners coming in and buying Portuguese debt. So again, I don't mind, being hyper-focused on the dollar and checking out and making sure that my thesis is correct. But to the people who tell me to check these things out, check those things out as well. Don't be a hypocrite to yourself. You can lie to other people, but don't lie to yourself. Hold yourself to the same account. And the point is all of the things that everybody is afraid is going to happen to the US government and the US dollar is already happening elsewhere.
Yeah.
And so, it's not to say that it can't happen here. I think it actually will happen here, but it's not happening yet.
Yeah. And I think the main takeaway there is you have to be able to argue the other side of the debate. Absolutely. Even better than you can argue your own view. To be able to sleep well at night, knowing that you have a complete picture and you're truly understanding the probabilities of XYZ outcome. So many people get caught up in just their this tunnel vision of their own view. And it's even difficult for them to articulate someone else's view. And you've got to be able to not only articulate the view, the opposite view, but you need to be able to argue it better than they can. And that's I think if people could just do that, that in and of itself would make them far better investors.
Agree.
All right, buddy. I know I kept you longer than the 45 minutes, so sorry about that.
Okay. That's all right. No problem. I could talk to you forever. No problem.
I know, it's great. I can't wait to see you in Miami. So for my viewers and listeners who want to find out more about what you do, where can they go?
Well, obviously check out the Rebel Capitalist. I do that once a month. And then I think you can find all my old interviews on your site if you search for them. Just go to YouTube and type in Brent Johnson, Santiago Capital. You'll get tons of links to a number of different either podcasts or presentations that I've done. And you know what? Come to Miami. Miami is one of my favorite cities in the world. I think it's one of the most underrated. It's a great place to go. It's always fun. It's sunny. The water's great. And, your conference last year was the first conference I had gone to kind of post-COVID.
Oh, really?
And it was fantastic and it was fun. So I'm really looking forward to doing it again.
Yeah, you got to come and you got to check out Brent wearing Vans. Are you going to bring your checkered van? Everyone was talking about that. That's so cool. I just met Brent Johnson and he was wearing those old school checkered Vans.
Oh yeah, I'll definitely wear Vans. I'll bring a suit this year too. Maybe I'll put on a tie. We'll see.
All right, man. Then for the other people, definitely follow Brent on Twitter as well. That's always fun. What's your Twitter handle?
Oh yeah, so it's a Santiago AU Fund is the Twitter handle. I think if you just type in Santiago Capital in the search engine. Also, it'll come up. It's the black and gold seashell.
Yeah. All right, man. Have a good one. Enjoy your day in PR there at the coffee shop on the corner.
Yeah, right.
We go to.
That's right.
And we'll see you soon in Miami.
All right, man. Thanks.
Hello, fellow Rebel Capitalists. Do you enjoy watching these interviews I do for the Rebel Capitalist Show? Well, if so, you would absolutely love Rebel Capitalist Live. This is the conference I do twice per year, and we've had speakers like Robert Kiyosaki, Lynn Alden, Rick Rule, Jeff Snyder, and Dr. Ron Paul, just to name a few. So go to rebelcapitalistlive.com and check out the next event we have scheduled in Miami.